Hey everyone, this is Matt with the Fundamental Investing Institute. Thank you for tuning in today. We're continuing our lecture series on the history of the Federal Reserve. And in the last video, we discussed the relatively short-lived but deep recession of 1920-1921 when the Federal Reserve raised interest rates, left them very high for a period of time. As rates came down, the economy went through a very aggressive economic expansion. Of course, this period became known as the Roaring 1920s. And you saw innovation in the automobile industry, in entertainment. You started to see the rise of mass consumption at the time. Now, the Federal Reserve, some changes were happening, one of which you started to see a greater degree of policy coordination. So even though the individual reserve banks were largely autonomous, they started to coordinate better, and they started to sort of toy with a policy. Became the key policy in the post-war era, but at this point they started to really utilize a policy known as open market operations. Open market operations involved the Federal Reserve buying government securities from member banks and paying for those purchases by increasing the reserves of those banks. So it's a way that the Federal Reserve can increase the money supply. Now, in the post-war, post-World War II period, and we'll discuss this in later videos, this tool becomes the predominant tool. But in the 1920s, it's really kind of a supplementary measure that the Fed is kind of using at the margin. Their key tool is the discount rate, where they would lend against acceptable collateral. Now, a key figure in the 1920s is a man by the name of Benjamin Strong. He's the governor of the New York Federal Reserve. And by virtue of Strong's leadership, his personality, and by virtue of the New York Federal Reserve being the center of the money market in the United States and increasingly internationally, Strong becomes the de facto leader of the Federal Reserve in the 1920s. Now, remember that the belligerent countries in World War I suspended gold convertibility, so they ended the gold standard in 1914. And a number of countries are trying to get back onto the gold standard in the 1920s, particularly Britain. And the Bank of England, so the central bank in Britain, is led by someone named Montague Norman. Norman and Strong had a very significant working relationship and even friendship. Now, Britain was trying to get back onto the gold standard at a conversion rate between the dollar and the pound that existed prior to the war. And this vastly required the Bank of England to increase interest rates significantly because they did not have the gold supply necessary to support it. The Federal Reserve, on the other hand, because of their very aggressive tightening in the early 20s, had the plurality of the world gold stock. So you have a coordinated policy in the mid-1920s between Strong and Norman, where England would keep rates very high. This was a very tight policy, caused a lot of labor unrest, but they kept interest rates very high. And in the United States, the Federal Reserve kept interest rates artificially low. This encouraged gold to flow outside from the United States into Britain, and it helped Britain restore the gold standard for a period. Now, what this does in the United States is it helps fuel an increasing stock market bubble, which begins in the latter half of the 1920s. We should also note that stock purchases were being increasingly done on margin. Margin is borrowed money from a broker. The brokerages themselves would borrow money in a wholesale market called the call money market. The call money market is where the brokers would borrow from banks, but this is one of the most lucrative areas of lending for commercial banks in the late 1920s. Now, what we start to see a little later in the 27, 28, and into 29 period is the Federal Reserve starting to get very nervous about this speculative excess. In our next video, we're going to discuss the crash, but the point that I want to make in this video is beginning in the 1920s, the Federal Reserve is starting to tinker with policies to tighten interest rates to try to reduce speculation, and it begins to cause cracks in a very fragile stock market and a very fragile banking system. We'll discuss this more in our next video. We will end there for now. Thank you for tuning in, everyone.